We will now discuss the accounting for multiple performance obligations, or POs. If a contract has multiple performance obligations, or POs, then we need to revisit steps 2 and 4 of our 5-step process, which we discussed previously. Step 2 is identify the POs. Step 4 is allocate that transaction price to each of those POs. So let's look a bit more closely at step number 2, which is identify the performance obligations. Goods and services are typically viewed as distinct if they are both separately identifiable from other goods and services, and 2, the customer could use the good or service on its own instead. Let's now review the data for an example of when to determine revenue recognition when you're dealing with multiple POs. Let's say Davis Inc. is selling gaming systems. The gaming box itself sells for $240. We also offer a 1-year subscription of those gaming items for $60 a year. Please note the combination of those two would be $300 as a combined price. But we want to make this attractive for our customers, so we offer a package price for both those items at $250. On January 1st, 2017, Davis Inc. sells 1,000 of these packages. So now we identify the performance obligations. In this example, there are 2 POs, the gaming box as well as the annual subscription. The next step is to determine the overall transaction price. Well, if I sell 1,000 packages at a cost of $250 a package, that's basically $250,000 in total. Step 4 is to allocate the transaction price to each of those performance obligations based on what their current standalone selling prices are. Keep in mind the gaming modules were $240, which represented 80% of our total, and the subscription was $60, which is 20% of our total. Thus, our entry here would be a debit to cash or receivables for $250,000, a credit to sales revenue in our income statement for $200,000, which is 80% of the value, and then a credit to deferred or unearned revenue for the remaining $50,000, which is 20% of that total value. Hopefully you've just followed through the various calculations I've just reviewed. The key point here is that the multiple POs, I need to allocate this transaction price on some equitable basis, such as standing alone selling prices. In summary, the module revenue of $200,000 is earned revenue in our income statement, and the $50,000 subscription revenue is unearned or deferred, which is a liability in our balance sheet. Thus, we will recognize 1/12 or $41.67 each month over the next 12 months as earned revenue.